You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome in to Options Playbook Radio. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for about the next 12 minutes here on OPR. Today's date is Tuesday, January 27th, 2026, and today we're seeing United Healthcare dropping precipitously after an announcement by the current administration that their plans are to keep the 2027 Medicare Advantage payment rates nearly flat, which has caused the stock to drop by about 20%. The outlook anticipated was about a 4 to 6% increase. At least that's what the analysts expected. I hold United Healthcare in my portfolio, and also Warren Buffett holds United Healthcare. Berkshire Hathaway bought a stake in the second quarter of 2025, about a $1.6 billion stake, approximately 5 million shares. And I'm sure it's not worth $1.6 billion at this point in time. But if you do have United Healthcare and you're kind of looking for the dead cat bounce in the underlying stock, with volatilities high, there's a trade that I wanted to talk to you about that I'll be looking to do inside my own account. Now, as always on Options Playbook Radio, nothing is meant to be a recommendation, and you do have to at least have 100 shares of United Healthcare to do this trade. But the trade that I'm looking at doing is called a front spread, and we're going to use call options. So if you go to optionsplaybook.com right now, and in the search box you type in front spread, you want to look at the call version of the front spread. Now, here's what's really important is that if you're doing a front spread, it's a 1-by-2 ratio spread. You're going to buy one option contract and sell two option contracts. And normally that would make you have unlimited risk to the upside. Why? Because you're only long one option and you're short two options. Now, if you have 100 shares of stock, in this case UNH, then you are covered on that second call option. Now, some people will call this a covered call on steroids. I like to say, I don't want the cheese anymore, just let me out of the trap. But you have to act quickly when there is a big news event that drives the stock down, and it's going down not because of the fundamentals of the company, but the potential that could happen if the administration gets its way right now, and there is zero increase in Medicare payments. So it's going to take a little bit of time to play out. There are quite a few people that are saying this is a little bit overdone. I'm not 100% sure, but I do know that if you act fast, you have the potential to don't let the cheese anymore, just let me out of the trap. And that's exactly what we're going to do. So right now, UNH is at $281.70. It is down about 68.5 points. That's pretty close to 20%. We're going to go out 31 days. That puts us at the March 6th, 2026 expiration. And we have to go a little bit out of the money. The stock has actually dropped too much in order to this strategy to allow us to break even if we get a strong bounce back after the fact. But we're going to be buying the 300 calls, so this doesn't really help out unless we get to that 300 strike. And then we're going to be selling two of the 315 strike calls, both with that March 6th expiration, which means they're both 31 days out. Now, with this trade, we can, if we buy one of the more expensive options and we sell 2 of the cheaper options. Right now, the midpoint is really bouncing around because the markets are open, and we're about, I'm going to call this a net credit of $1 to the account. Now, if we do this trade, what we want is the underlying stock to bounce back to about the $315 level. This pumped up implied volatility is allowing us to put this trade on. Very important, I'm going to emphasize it more than once, that you must have 100 shares of stock per 1/2 front spread that you put on. That 100 shares of stock makes that second call option covered. And what this does for you is from 300 to 315, it's basically like owning the stock on margin. Instead of owning 100 shares, you're going to own 200 shares. That second 100 shares comes from the 300 strike call option. So from 300 to 315 at expiration, 31 days away, March 6th, if the stock is above 315, you will make $15 in that range on the stock and $15 on the option trade. Hence, you make $30 as opposed to just making the $15 from the stock. Now, it obligates you to give up the stock. And at this point in time, considering United Healthcare was trading right around $350 most recently, the company announced earnings, and to add fuel to the fire, they posted a modest fourth quarter earnings beat, but they issued soft revenue guidance. So the stock was down a little bit from the earnings report, but that was nothing compared to the news out of Washington. So if you're doing this trade, let's rehash. We're going to go out 31 days. The strategy is actually called a front spread. It assumes that you own at least 100 shares of UNH. You're going to buy one of the 300 strike March 6th expiration calls and sell 2 of the 315 strike March 6th expiration calls. And we're going to get this done for a net credit of $1 to the account. It will obligate you to sell your 100 shares above $315. If the market goes down and both the options expire worthless, you get to keep the dollar. But more importantly, if the market is going down and you're more worried that the piling on is going to happen to the downside, you can always close out the position and then sell the stock. If the market is going down, the position should be profitable on the option strategy, i.e. the front spread. That's it for this edition of Options Playbook Radio. If you'd like to learn more about these strategies, please check out optionsplaybook.com, and we'll be back shortly. I think the next trade I want to look at doing is a potential trade in VIX options around a potential government shutdown heading into the weekend. All right, thanks for tuning in.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.